Think deep, trade smart. This video is presented by Meitou Investing.
Hello, what's up guys? Welcome back to another Meitou video. So far we got 2 videos for the option series, and today's video will make it third. So what I really want to accomplish through these videos is to teach the fundamentals of option trading, as well as demonstrating ways you can do to generate more income and hedging against market risks. In the last video, I've briefly explained naked put selling. This is the strategy that can generate stable income in the long term. It has relatively low risk and can cope with more complex market situations. For example, whenever the market is extremely pessimistic or when the market is steadily rising, naked put selling is going to be an excellent money-making strategy. So having said that, at the end of the last video, I have promised to introduce you to another strategy that will help you to deal with market risk, which is hedging. And this strategy is called cover call. While naked put selling is the best way to make money over the long term, the best thing about cover call is that it's a money generator that also comes along with hedging, which is often the best trading strategy for a market that is fluctuating back and forth, or just full of uncertainties. And before we go into the main course, if you found my videos helpful, you are more than welcome to share this channel to your friends who also like learning about investment knowledge, and that would be really appreciated. And if you haven't subscribed yet, please don't forget to subscribe at the end of the video. Your supports are my motivations to make more quality videos in the future. So let's explain the logic of this strategy first. Cover call is divided into 2 parts. One is that you're holding the stock shares, and the other is to sell the call option of these shares. To buy a call option is to be bullish on the stock, and to sell a call is to be bearish on the respective stock. So you might find it strange, like why would you sell a call on the stock that you're really bullish on it? And how does a strategy make you money and how does it do hedging? Well, this brings us to the feature of option. Because there's a strike price, the way you're bullish or bearish in terms of option is completely different from trading shares. For example, if you own a stock, you're essentially saying that you think the stock is going to go up in the future. Thus, your profit is determined on how much it rises. But option is different. Even though buy a call means that you're bullish, you only make profits if the stock price is higher than the strike price. And a sell call option means you're bearish, and you will lose money if the stock price is higher than the strike price. And the higher the difference, the more you'll lose. On the contrary, when you sell a call, you make profits only if the stock price is lower than the strike price, which means you're bearish about the stock price to be higher than the strike price. The reason why people sell a call is because they think the stock price will not rise above the strike price before the expiration dates. So then, you can earn the premium by selling the call. The logic of a cover call may seem complicated, but the simple logic is that you sacrifice a portion of the stock's future upside potential in exchange for a portion of the income that you can earn today. And that portion of the income is the premium you earn by selling the call. So to better explain this cover call strategy, I'd like to give you some of my investment cases. The type of the stocks used in a cover call strategy are those held for a long-term investment and whose prices are relatively stable. So let's use McDonald's as an example. It's one of my longest holdings, and it's one of the best long-term investment that I have. And I have used the cover call strategy on McDonald's for a very long time, which in turn gave me some decent amount of extra income. On June 19, 2020, McDonald's stock price was at $186 a share. I sold a call option at a strike price of $190, which expired in 1 week. I sold this option and made a total premium of $220. The reason for this move is that McDonald's stock price has long been fluctuating at a relatively smaller rate, which I didn't expect the stock to rise above $190 in just a week. And even if McDonald's does go above $190 a share, I was willing to sacrifice the excess to get the $220 premium. In the end, a week later, McDonald's stock price dropped from $186 a share to $180 a share, which I was able to secure the $220 premium. Even though the stock price did fall for a bit, I was fortunate because the premium helped me to cover some of the losses. So some of you may think that this $220 premium is not much of a big deal, but let me show you this simple math and you will see why this is relevant. A $220 premium income within just a week is equal to 1.18% of the $18,600 value of my 100 shares of McDonald's. So if my cover call strategy was successful traded each week, my return in a year would be 61% of my total holding. And of course, no one gets it right all the time. But if you get it right half of the time, that's still a 30% return in just a year. And that is pretty significant. It's worth noting that the cover call won't lose you money on its own. So even if you're wrong and that the stock price rises above the strike price, the only risk you're gonna have is that you will make less money, which is equal to the amount of the difference between the strike price and the stock price that was higher than your strike price. Another way to use cover call strategy is to use the money earned from selling the calls to cover your potential losses. This is especially true if you want to buy a stock that you're really uncertain about. So on June 11, 2020, the stock market suffered the worst one-day drop since March. Among the stocks that fell the most, Boeing dropped 16.5% in just a single day. So I thought that was a good time to buy Boeing, which given the fact that Boeing's fundamentals are still in a good shape. However, at the time, market uncertainty is still high, and there's still possibility for Boeing to drop further. So at the same time when I bought Boeing at $170 a share, I sold a call option at a $220 strike price, which expires in just 2 months, with a $13 premium per share. So a $13 call option price equals to 7.6% of my stock expense, which would cover a 7.6% decline of my Boeing shares. The logic is that if Boeing goes up more than $220 in just 2 months, then I have to sell my shares at $220 per share, which is essentially a stock profits price for myself. But even if that happens, I'm still pretty happy with a 30% stock return plus a 7.6 option return over just 2-month period. So from the above examples, you know that cover call could make you lose the potential gains for holding the shares, since you would have to exercise the option when the stock price rises above your strike price. In both cases, I have set the strike price at which even if I eventually exercise the option, I still have a very decent return. And even if they did go above my strike price, in turn, I would still earn my premium. In addition, even if the market uncertainty continues to temper, from the McDonald's example, by doing the cover call strategy, I can still hedge against any potential decline on the strike price because I have my premium to cover up some of my losses. There are many more techniques of using cover call, such as how to set up your strike price, in what situation should you use it, and how to avoid any special events, and etc. If this video gets more than 1500 likes, I will make another video in the future on the above issues. So if I can do option, I bet you can do the same as long as you gain enough experience and knowledge.
If you like my videos, please click the subscribe button. Your supports are much appreciated.